We covered so much up until now, but without a proper understanding of market direction, it is unlikely that you will succeed. William O'Neill, in his investing classic, How to Make Money in Stocks, noted that if you're wrong on market direction, 3 of 4 stocks will plummet with the averages. Also, 80 to 90% of bases are formed in market corrections. So you can never really step away just because the market's in correction. In fact, most people come back to the market after a big rally and they buy these stocks way too high. And that's a reason why most people who try to actively invest lose in the market. Rather than respond to market trends objectively, they respond emotionally, and they always sell at the wrong time and buy at the wrong time. The truth is that most people have no way to judge market trend. If you want confidence in your system, I really recommend you go back and study year by year in the market. How would those market conditions have impacted you? I use 2 methods to interpret market action. My favorite tool is net new highs. In fact, this is something I discovered rather recently. The author John Boyk, who's written several great books on investing, and I recommend that you take a look at them, start to speak about net new highs in the marketplace. And so I dove in and I found some great insights that we're going to speak about shortly. It essentially shows both the trend of the marketplace and the internals of the market, and really gives a true picture of what's going on in the market. The second tool that I use is the follow-through day, which was created by William O'Neill. The reason I use this tool in addition to net new highs and lows is that it's battle-tested, it provides a pivotal day that requires your action, and How to Make Money in Stocks has many great examples you can go back and study. Now, let's dive in. Let's take a look at these different examples and these different tools and see how they can help you determine market direction. Here we have a daily chart of the NASDAQ composite. I primarily use the NASDAQ composite as my benchmark because a lot of the stocks I invest in are growth-oriented and they predominantly exist on the NASDAQ composite. We see the daily bars on the upper end of the graph, and on the bottom panel is where we get a lot of information about the number of net new highs in the marketplace. So this first plot here in blue shows the number of NASDAQ stocks making a new 52-week high on the day. And the yellow plot underneath shows the number of stocks making a new 52-week low on the day. So as you can see here in late 2018, the number of new highs that were taking place in the marketplace were diminishing rather significantly, whereas the number of new lows occurring were really expanding rather quickly. And I like to visualize that through a net number. So essentially the plot down here is the net between new highs and new lows. So if we're showing green bars in this plot, essentially there's overall net new highs, and if we're showing red bars, there's net new lows. And that really gives a great internal dynamic view of the marketplace. Now, in a good market that's trending higher, most stocks are making new highs, and at least there's more stocks making new highs rather than new lows. And really this net number gives a great view of the marketplace. But I really like to take it one step further and look at the trend of the net new highs and net new lows. At first glance, this may look a little bit confusing, but it'll become clearer to you rather quickly. What I like to look at here is 3 consecutive days of net new lows or net new highs to signal a bullish or bearish trend. So as you can see here, I've painted the background red or green to signify if we're in a bullish or bearish trend. So here we were in somewhat of a bullish trend, and when we get to the white space, essentially there aren't 3 consecutive days of net new highs or net new lows. So once we enter this white space here, we start to count the number of net new lows days in a row, and you see after 3 consecutive days of net new lows, we enter a red condition, which means we're in a bearish trend. Similarly here, once we're in a bearish trend for a significant amount of time, once we have 3 days of net new highs in a row consecutively, we enter a bullish trend. This obviously was a false signal, and we fell over rather quickly, but it's just a good way to demonstrate what the background colors are actually displaying here on the marketplace. This is 2015, and this is a good example here. You can see we had a bullish condition for the majority of the market advance. You can see that by the fact that the background is painted green here for the majority of the advance, and you can see net new highs are predominantly to the upside. There are a few times here where you have white space in the background indicating either no consecutive 3 days up or down, and a very short moment where you had 3 consecutive days of net new lows. However, that's flipped back to positive relatively quickly. And really, you want to look for those trends to develop. So the fact that once you enter that green background, 3 days of net new highs, you want to have a bullish mindset. Similarly, once you start to flip to 3 days of net new lows, you have to be rather cautious in the marketplace. And you can see here, as the market started to enter a topping phase, you start to kind of flip-flop back and forth between net new highs, net new lows. Now, this is not a perfect indicator. There aren't any perfect indicators out there, but it really does draw to your attention the internals of the marketplace and what's going on. And it's rather important that you use the internals of the marketplace. By that, I mean what all the stocks are doing in terms of net new highs, rather than just the indexes themselves, because oftentimes you can have these indexes rather concentrated in some of the biggest stocks in the world, such as Apple, Microsoft, and those can give a skewed picture of what's actually going on in the marketplace. So for example, if the big tech stocks, Microsoft, Apple, Google, and Facebook are climbing on the day, there's such a heavy weight on the market that even if there are many, many smaller mid-cap stocks falling, the market may deceivingly show that it's up on the day, whereas net new lows may show that there's actually the majority of the stocks that are falling. And so if you're not invested in one of those big 5 stocks, the net numbers here that we're looking at are a much truer picture of market action than just the indexes themselves. Here we're looking back at 2006, and we can see for the majority of the uptrend, we were under bullish conditions, and just as the market started to break down, we entered into negative conditions signified by the net new lows on the bottom of the screen. As soon as the market correction started to end, we can see rather quickly we entered back into a condition of net new highs, and this had you positioned rather bullishly for the majority of the advance. I think the perfect example here would be 2008 and the financial crisis. You can see we entered really net new lows rather early on in this trend, right off the absolute highs of the marketplace. And that condition stayed in place pretty much right until the end of the bear market. Now, what I find especially interesting is that even as the market had these rallies to the 200-day moving average, you got above a lot of moving averages here in the process. You were above your 50-day moving average, signified by the red line. You were above your 20-day moving average, signified by the green line. And for a short period of time, you were also above your 200-day moving average, which is the blue line. And so traditional trend techniques would possibly have you starting to look for long positions because you're above your moving averages. However, the net new lows really displayed the weakness underneath the surface in this market. And you can see the entire time there was really a dramatic amount of net new lows taking place. And that really did switch as the bear market ended and the bull market began. You can see that even clearer. This is where that previous chart ends, and this is where it continues. And for the majority of the bull market, you had net new highs the entire time. So it really had you positioned strongly for the entire bull market. And really, as that market trend exhausted itself, you start to get back to that choppy phase. And really, a choppy market like this is difficult no matter what kind of tools you're using. However, this will keep you in line and prevent you from really being caught off guard if a big bear market develops, or prevent you from not being invested if a big bull market develops. Let's take a quick look at the COVID crash and really how quickly this can adapt and really identify problems. This really did help me move quickly in a fast-moving market. Now, coming off of the trade tensions that ended in 2019 between the US and China, we had a nice bullish condition that was achieved for several months. And I remember here, actually in late January, the first worries about COVID began, and we had a rather sharp break in the market. And the market managed to snap back relatively quickly, but underneath the hood, there was quite a bit of damage that took place. And although the market went sideways here, you did get a point where you had 3 days of consecutive net new lows. That condition did flip to the upside, but again, very quickly, as we broke lower, this condition turned negative. And I remember I actually did exit right here as I saw net new lows show up and we had this big gap down. If you were just waiting for traditional trend techniques, you may have only sold much lower as you broke your 200-day moving average or what other techniques you were using to define your trend. And rather quickly off of the low, you can see this had you positioned rather bullishly really quickly here. We're all the way back in April, and you were able to capture sizable advances in the marketplace just using your net new highs and net new lows as your guide. The next tool I want to look at is the follow-through day. So this was really designed and created by William O'Neill, and the point of this is to help you identify when a bearish trend is ending and when a new bull market is beginning. The idea behind it is rather simple, but it's extremely effective and it works great, and I've used it for many, many years. Essentially how this works is once you're in a downward market, you look for a first day up. Essentially, this is day one. We have an advancing day. This would be day one in the marketplace. As long as this low is not broken, that count continues. Starting at day 4 or later, any day where the NASDAQ is up more than 1.25% and volume is higher than the prior day, you have a follow-through day. So here we have day 1, and on the 10th day of this rally attempt, those conditions come true. So we get our follow-through day. The index is up more than 1.25%. It was actually up 7.3% on the day, which was a monster up day. and volume was higher than the prior day. It doesn't have to be higher than average, it has to be higher than the prior day. And in fact, this is one of the tools I use to begin buying stock, and the first stock I bought was Livongo at $27 and change, and that went on to be a monster winner in the 2020 bull market that then ensued. And so the follow through day is really designed to force you to realize that that downtrend may be ending, and we have institutions coming back into the market rather aggressively. And one of the key points here that I alluded to in the risk management section is when you see this follow through day happen, you have to react and increase your exposure somewhat in the marketplace. You have to change your mindset. That's what I love about the follow through day. The fact that it's a significant day in and of itself forces you to react to market conditions, and regardless of what your thoughts are in the marketplace, whether you're bearish or bullish, you need to buy some stock. You have to look around who your leaders are, what stocks in the best buyable position, and put on some exposure because the market has had a significant change and you need to react. Here is an example that is not as ideal as the 2020 follow through day that launched that great big bull market. In early 2016, we were in a rather significant drop in the marketplace, and we had a day one of a rally attempt. I know here you'll notice that it's actually down on the day, but if the stock market closes significantly off the low of the day, as we did here, that can count as a day one of a rally attempt. Traditionally, you want that to close in the upper 80% of the day's range to qualify. So we had day one of a rally attempt, and on the 8th day, the NASDAQ was up greater than 1.25%. It was actually up 2.38% for the day, and volume was higher than the prior day. So this is your follow through day, and you should be thinking bullishly at this point and looking for buying opportunities. Unfortunately, it was a failed follow through day, and you know that rather quickly by the fact that you rolled over just a couple of days later. But the rally officially fails once you take out the low and you're making new lows in the marketplace. So although you do want to react when you see a follow through day, that doesn't mean you buy with abandon. It just means that you should be perhaps changing your mindset and not being overly focused on the negatives in the marketplace and trying to figure out what is positive going on in the marketplace. This didn't work out well here, but in 2020, the entire world was extremely pessimistic. I mean, it seemed like the end of the world and everything was shutting down. How could you possibly imagine that this great big bull market would start in April of 2020? But it did. So this is really, again, an indicator that forces you to react, and you have to put all of your prejudice and your thought aside and really focus on the market action. So although that failed, shortly after we had a day one rally attempt again where we closed in the upper range of the day, and we had a day four follow through day where the market was up more than 1.25%. In fact, it was up 2.21% for the day, and the volume was greater than the day before. And what's interesting here as well is that this follow through day came quite a bit of time before we started to get net new highs. So you have these two tools that can both work, and if either of these start to show up, you really want to start to change your mindset. Now, just because you see a bull or bear market doesn't mean you have to completely change all of your thinking. You have so many tools. However, if you start to see the signs of a bull market, you really want to start drilling down, finding these great growth companies, looking for these properly formed shaper patterns, and then using all of your tactical tools to adapt to the changing marketplace. There's another benefit of having all of these tools, is that you could really move much quicker when the market is changing quickly, rather than having to wait for just these signals that would occur much less frequently on weekly charts. Now, all of this may seem a little bit confusing and even somewhat frustrating, because once you've found this great company and you want to buy it, do you really have to wait simply because the market isn't strong? I mean, if the stock is destined to be a major success, is this extra step really necessary? And how could you make this all a little bit simpler? Well, I'm going to provide the script for you that you can use in TradingView, which is a free investing tool on the internet at tradingview.com. And you can have these green and red backgrounds to really help guide you and provide an objective view of what the market is doing and help you to adapt. But let's take a look at some of history's best stock runs, and let's see what the impact of the market had on those stocks. Was it necessary to really wait for those bullish market conditions before you look for buy points? Let's take a look. This is Apple Computers once again, and again, here we see we went on this massive advance from late 2016 up until the middle of 2018, where we advanced from about $28 a share to just about 57. And you can really see the majority of the advances took place against a green backdrop. And this very large significant decline occurred once the market conditions started to turn negative. So ideally, you really do want to start looking for these buy points in these bullish conditions. Again, even these shorter term blips in the marketplace where you see these red indications for very short periods of time, although you didn't always kick off into a big bear market, that was also the point where you had quite a bit of volatility in that stock, and it would have been rather difficult to buy and hold onto the stock at those points. If you would have waited for those green market conditions, or where you had 3 days of net new highs in a row, that was really the ideal time to be putting on exposure and looking for all of these great buy points. Again, also here in the middle of 2019, as the market went from green conditions to neutral and even to red, you had again another big drop in the price of Apple Computer. And Apple is one of history's greatest stock advances. So to see the market have this much of an impact on Apple, which is a real leader in the marketplace, you can imagine that weaker stocks were even further impacted by market declines. Again, not every stock goes up with the market, only the best do, but virtually every stock will decline when that market turns negative. This is Deckers Outdoor, and they made those UGG boots, which were so incredibly popular in 2006 and actually still are today. And you can see this had an enormous advance. I mean, we went from $10 here in 2006 to over $120 a share in 2011. And if you look at where all the majority of the gains were made, it was really under the green condition. And you can see as soon as the market turned into a negative condition here with 3 days of net new lows in a row, that's really where you had all the downside risk and all the increased volatility. And rather quickly at the bottom here, as we turn back into a bullish market condition, that's where it became much easier to buy stock once again. And again, also here, similar to Apple, even though there are short-term blips in the marketplace where you had 3 days of net new lows in a red condition, that is also the point where you had volatility in the stock and would have been rather difficult to initiate. Now, if you already held a position and you had quite a bit of cushion because you bought it lower, perhaps you could have stayed in that position. But if you were trying to initiate under these negative conditions, it's very likely you would have been stopped out in the process. And you can see these big, great advances, these nice legs up, always occurred under these bullish market conditions. So it's such a simple tool. It's very objective. You can put it on your screen. And essentially, you can really only look for these buy points in these great stocks when the market is cooperating with you. This is the Monster Beverage Corporation, where they really kicked off all the energy drink craze back in the middle 2000s. And you can see this stock went from, this is split adjusted, of course, but from about $1 a share to almost $9 a share in a relatively short period of time, just a little over a year. And you can see the best place to put on exposure of this stock was under the bullish market conditions. And whenever we had the market get into either neutral or negative conditions, the stock pretty much went sideways and got a little bit volatile. Here again, as the market got into a bullish condition, we really started this huge leg higher. And just as the stock was entering actually a climax top, that's when the market started to change condition negative again. You really want to take your hard-earned profits before the stock eventually gave it up and fell with the market and crashed lower. And so really, this is another great example of how even despite the stock going on an approximate 9-fold move, the best time to buy the stock was under bullish conditions, and you really had to be careful when the market changed direction. Here is Square, and again, another major winner in the COVID bull market. But this was also a major winner prior to that. And I just want to show you here how the majority of the major up legs again occurred under very bullish market conditions. And just as the market conditions changed to negative net new lows here and a red backdrop, that's when the stock had pretty much went to nosedive from 100 down to about $50 a share. And as the market recovered and went green, the stock stabilized once again. And really, this just goes to show how dependent the stock is on the market. And now, not here, the stock kind of lost its leadership status for some time, and it didn't react to the upside very strongly. But as soon as the market turned negative, this just fell over rather dramatically. So again, not all stocks go up, but all stocks will go down in a bad market. So you really want to pay attention when you start having 3 days of net new lows in the market. You don't need to panic, but you want to start reducing exposure, and you really want to be looking around for major sell rules so you don't get caught in any of these really quick downward drops. Now, this was the COVID crash here that caused this big drop, but in late 2018, the market didn't have as significant a drop, but this stock did fall 50% regardless. That's rather significant, and if you weren't ready to lock in all of your gains from this prior big uptrend, you gave them back fairly quickly. As well, if you weren't ready to be buying stock, you would have missed this huge bull market. And this really did start to take off in April as that follow-through day occurred. Also when the net new highs started to come back in with this green backdrop, and that would have allowed you to get in around $60 a share before the stock multiplied several fold higher. So it's really important that you use these market backdrops. It'll really help guide you, keep you out of trouble in bear markets, and force you to be positioned long in bull markets.